Imagine a corporate empire, built on innovation, ambition, and an insatiable hunger for growth. Its market valuation soared, its executives were lauded as visionaries, and its financial statements painted a picture of unassailable success. Yet, beneath the polished facade, a meticulously crafted illusion was taking hold, one that would ultimately lead to one of the most spectacular strategic collapses in modern business history. This is the Enron game: data deception and strategic collapse. Enron Corporation, once heralded as the world's most innovative company for 6 consecutive years, embodied the aggressive, deregulated energy markets of the 1990s. From an oil and gas pipeline company, it swiftly transformed itself into a global powerhouse, pioneering energy trading, broadband, and even weather derivatives. On the surface, Enron was a strategic masterpiece, constantly reinventing, expanding, and seemingly defying economic gravity. Enron's strategic advantages were undeniable: a keen understanding of deregulation, an aggressive expansion into new markets, and a corporate culture that rewarded audacious risk-taking and innovation. They established an open platform trading system for natural gas, revolutionizing the industry by turning physical commodities into financial instruments. This rapid growth, coupled with high-stakes financial wizardry, propelled Enron's stock price to unprecedented heights. It was a company that seemed to always win, constantly pushing the boundaries of what was possible in the energy sector. But beneath this veneer of brilliance lay a sophisticated system of financial deception. The core of Enron's strategy of obfuscation rested on 2 key tactical instruments: special purpose vehicles, or SPVs, and the aggressive application of mark-to-market accounting. SPVs were created to serve a specific, often narrow purpose. For Enron, these were shell companies, structured to appear independent, yet secretly controlled by Enron executives. The strategic genius and ultimate downfall was their use to hide Enron's debt and failing assets off its balance sheet. Through these SPVs, Enron could transfer troubled assets or guarantee the debt of ventures that were losing money, without these transactions ever appearing on their official financial statements. This tactic allowed them to inflate earnings and conceal liabilities, presenting a falsely robust financial picture to investors and analysts, coupled with mark-to-market accounting, which allowed them to record the future estimated profits of long-term contracts immediately upon signing. Enron could manufacture earnings out of thin air, creating an illusion of unstoppable profitability. It was a daring gambit, designed to bypass traditional financial scrutiny and keep the stock price climbing, regardless of underlying performance. No illusion, however meticulously constructed, can last forever when the underlying reality is fundamentally unsound. The first significant cracks appeared in early 2001. Internal concerns, initially dismissed, began to escalate. Bethany McLean's now famous Fortune article questioning Enron's opaque accounting practices ignited external scrutiny. The strategic errors in maintaining the deception became critical. The SPVs were too numerous, too complex, and too reliant on ever-increasing revenue to cover prior losses. When internal whistleblower Sharon Watkins sent a memo warning CEO Kenneth Lay of accounting improprieties, the internal alarm bells were finally too loud to ignore. The dominoes began to fall rapidly. The Securities and Exchange Commission, or SEC, launched a formal investigation. Enron was forced to restate its earnings, revealing staggering losses and previously hidden debt. Investor confidence evaporated overnight, triggering a catastrophic spiral. On December 2, 2001, Enron Corporation, once valued at over $60 billion, filed for Chapter 11 bankruptcy, the largest in U.S. history at the time. Thousands of employees lost their jobs and their pensions, while investors saw their holdings wiped out. The ripple effect was immense, leading to the collapse of its accounting firm Arthur Andersen, and prompting widespread regulatory reforms. It was the inevitable failure of a strategy built not on sustainable growth, but on audacious fraudulent data manipulation. The Enron game stands as a stark lesson in corporate hubris and the indispensable need for data integrity. Its collapse underscored that even the most innovative and aggressive strategic plays are ultimately unsustainable if built on deception. It forced a global re-evaluation of corporate governance, accounting practices, and the critical role of independent oversight, reminding us that true value can only be built on transparency, not obfuscation. Join us next time on the Boardroom Gambit, as we delve into the retail colossus's fall, Sears' slow decline, a cautionary tale of strategic inertia in the face of relentless market evolution. If you found this analysis insightful, be sure to like this video, share it with your colleagues, and subscribe to the Boardroom Gambit for more deep dives into the strategic plays that shape our world.